It's not about what's happening now. The retail management teams, the businesses are performing. They're performing digitally. They're performing in stores. Some of that's the economy, and some of that is the hard work that a lot of the retailers, including Target, did in terms of investing in 2016 and 17 when the business model wasn't working all that well. So that really created a tailwind to top line and, frankly, to return on capital coming into this year. And it's starting to, I wouldn't say wear off or that consumers are convincing themselves of something that's then going to happen, but it's really looking out into mid next year. That sugar high going away in terms of tax cut and the comparison.
So I
think that's what the conversation's really about today.
The brief rise that we saw in the retailers this year, was that about as good as it gets? Because for a brief time, right, the retail sector looked like a winning sector until maybe early this fall. And that's when arguably the consumer was probably at its best and we thought things were coming up roses for the economy. Now we're looking forward and we're already saying the consumer might fall off. There might be economic weakness coming into next year. Did we see the best of days for retailers in 2018 for this cycle?
Yes and no. I think it's a little more complicated, right? So what changed as the year went on? In early 2017, there were tremendous fears about a border adjustment tax. Those went away, but in 2018, we sort of got them backdoor through tariffs. That really changes 20, 30 years of competitive advantage that global supply chains have built for U.S. retailers. So that changed. And as that became more and more sort of factored into markets and conversations, that's changed the algorithm for what return on capital and growth are what companies are worth over time. So that's a piece of it, but lapping tax cuts a piece of it. And then we've done work on some macro data starting in May, and it started to look at some of the predictive numbers on housing, and that started to paint a different picture for next year. We can sort of dissect why interest rates are higher, maybe it's borrowing. But at the end of the day, that paints a little different picture next year, too. I think retail did a great job working on their models and inflecting return on capital, but some of the rules are changing, and that's making an impact.
Does Target deserve to be down, what is it down, 10% today, based on the fact that it came in at $117 a share, or I guess before items, compared with 87 cents a share in the year earlier? That is what? That's got to be a 33% profit jump. And same-store sales were up more than 5%. 2 years ago, 3 years ago, a lot of retailers would have given their left arm for that kind of same-store sales jump.
Right. I think Courtney said it. The day of earnings is all about expectations games. This week is all about holiday. This quarter is all about momentum and business models, of course, and then the season and next year. So I think that you're talking about, immediate reactions to small inflections, but the big conversations are about the business models, the supply chains, and the rules, that are at work.